actually find it encouraging because the public markets are being more rational in valuation than the private markets that are just awash with cash, and you have the SoftBank effect of putting so much money in these companies, WeWork and so forth. It's not a Ponzi scheme, but it's self-fulfilling prophecy and valuation. So they come to the public market says, wait, this is a little crazy. Lyft, they're not going to make money for we don't know when. The losses are going to pile up. Uber, Endeavor as well, losing a lot of money. So they're saying we don't want to do that. Unfortunately, it's impacting some of the higher valuation equities in the U.S. in the market. And we see that. You take a stock like Grub, you take a stock Roku, which had some news, but take a look at what's happened to that stock and others. So I don't think it means that we have a sustainable move into so-called value stocks, but I do believe that the pressure is going to be there for a little bit.
Yeah. So how do you see it, Josh?
I totally agree with what Steve just said. You had this thing where you had these huge pools of wealth, like the Vision Fund. Most weren't that egregious, but you just had this sense that you could keep raising the ante before the IPO and it would always pay off. And they would point to examples of that working on the NASDAQ in public companies. And then that stopped. And I actually think that if Uber were 70 right now, WeWork would be coming public today and it would be getting the full freight, 47 billion, whatever they wanted to do. I think Uber was a sea change. And I think that forced people to look and give much more scrutiny to the S1s being filed by companies like WeWork. And then people said, you know what, I'm not buying into this. So I do think that Vision Fund effect very much has changed the mindset. And IPO investors pushing back, again, I agree with Steve, that is what should happen. That is healthy. Investors should say, wait a minute, you have all the votes? Wait a minute, this is being valued as though it's the 50th largest company in the S&P right out of the gate. People are now saying these things, and they should have been saying them for a while. That being said, I do think that not every recent IPO is the same or of the same quality or has the same conflicts. So I think opportunities will be created as all of them get vomited up.
Okay, so I spoke with sort of one of our regular kind of tech and VC related guests who agreed with the take that Weiss and you have, that it's been healthy, that in his words, just the pretenders are the ones, Brenda, who you work out there, who are blowing up and who are sort of resetting the market the way that some had suggested may happen. Let's remember what CHAMATH told us a week or so ago, CHAMATH PALIHAPITIYA, and we can react to what he said on the other side as to whether it's healthy or not, whether the market can correct itself. Let's listen.
The thing we have to ask ourselves is, what did we expect to happen? Well, this is probably what was going to happen anyways. And now the question is, how can you course correct? And if you cannot, as you said, it's really up to the public markets to draw a hard line in the sand and say, enough, no more.
That's what's happening now, right? The market is saying enough, no more.
That's right. But I do think, as a reminder, we've been here before. Like way back in 2012, when Facebook went public, we had the same thing. It went public at a valuation that was too high. It became more of what I call a show-me stock, which I think is happening to many of the newly public companies, where public investors are saying, hey, wait a minute, show me you can execute on the plan, show me you have this business figured out, and then I will take a toehold or will invest in a more meaningful way. So with Facebook, as a reminder, it took it a year to get back to the IPO price after having gone public. So I don't think this is incredibly uncommon, but I agree with what others have said. This is a sign that the public market is a little more rational than what's happening in the private market right now.
Jimmy, I mean, is it a sign of a blow up before our eyes, an implosion, or are we overreacting to some of what we've seen because there have been some egregiously overpriced companies that have gone public? Bill Gurley, who we visited with a couple of weeks ago out in San Francisco, tweets yesterday, for those who are overly negative based on a company's first day of trading, which one of the following companies traded below their initial IPO price? He talks Amazon, Facebook, Salesforce, Netflix, Square, Palo Alto, and Proofpoint. The point he's making is, like, chill out.
Yeah.
All of them did.
Right.
And things are just fine now.
Well, so I see two questions in what you're asking. The first is, what's going on in the IPO market? Does it matter to the IPO market? And Mr. Gurley's comments, I think, are right. Look, if you're going to be an investor, give these investments time to play out. The second way of looking at the question, and the way that I look at it, is what does this bode for the market overall? Because, as you know, in general, Scott, I'm not going to participate in these IPOs. I mean, they're money-losing companies, and with a few exceptions, it's just not where I play. But traditionally, when you see an IPO market sputter like this, it does bode ill for the overall market. That is not the case right now. I am not worried about the overall market because so many other signs are giving you a green light. You know, you don't see any stress in credit spreads. You certainly have not had a blow-off top. I mean, I think that's inarguable that you haven't had a blow-off top in the market. I can go through some other things, but basically, this problem is located within the IPO market. Companies have waited too long to go public, and you know what? That pendulum will swing the other way just by the mechanism, the gear working of capitalism.